Hi, I'm Jim Jubak, and welcome to this week's Trend of the Week video. The Fed talks, but the market's not listening. Okay, what's really extraordinary, we've had this big rally in July on an idea that we're going to have a soft landing in the economy, that the Fed is going to stop raising interest rates because the economy is going to slow enough to bring down inflation, but we're not going to have a recession. The market is saying that, and it's reflected in the prices. This is a chart for the iShares 20-year Treasury bond ETF. It's a good surrogate for the bond market. And what you're seeing here is that sort of period of the July rally, the price of the ETF went up, which means the price of the bonds went up, which means the yield went down. So what we're really seeing is the 10-year, for example, go from a yield of 325 down to 270, 265. What the market is saying is, hey, we're thinking that we're going to get lower interest rates rather than higher interest rates, or the Fed is going to cut, whatever, and no recession. And that's reflected in this. This is the S&P chart. You notice that it also starts at about the same date and up, and I think it's a reflection of this belief in the market. The problem with this is the Fed keeps telling the market over and over again that it's wrong. We've had an extraordinary parade of Fed officials coming out and basically say, hey, we're not going to stop raising rates until we get inflation under control. And by under control, we don't mean 6%. It was 9%. Headline CPI inflation was 9.1% in June. Fighting inflation remains our major goal, and we really mean 2%. What the Fed has come out and said is, hey, you know, back in June when we did our dot plot, we were looking at saying, hey, end of 2022, we're looking at a Fed funds rate of 3.4%. Right now, it's 2.25 to 2.5%. And what the recent sort of parade of officials has said is that, hey, we really meant that. And in fact, we're still talking about, maybe even more. So maybe we're talking about ending 2022 with a Fed funds rate of 3.75, more than the 3.4 that we're looking at before. This is what we think we need to fight inflation. And the market is saying, we don't care. I can't hear you. Or just ignoring the whole thing and saying the Fed is wrong. Well, the Fed can't be wrong. The Fed can make bad decisions, but the Fed makes a decision, and the decision then ripples out through the market for better or worse. And I think what we're looking at here is the Fed telling the market that the market is being too optimistic, trying to talk the market back down so it doesn't get too surprised when it actually turns out that the Fed meant what it was going to say. And we're looking at, right now, there are only 3 meetings from now until the end of 2022. If we're going to get to the 3.75 end of the year rate on the Fed funds, we're looking at about 1.5 percentage points of increase. That means 50-50-50 at those 3 meetings, or 75-50-25, something like that. Still very hefty increases at those meetings. Otherwise, we're not going to get to where the Fed wants to be. And if the Fed is serious, and I think it is, the market is going to go, why didn't you tell us? And the Fed will say, we did, and you just weren't listening. This is Jim Jubak. If you liked this video, please give it a thumbs up, like us, subscribe to our YouTube channel. If you want more of my stuff, you can go to my free site, jubakpicks.com. It's got 3 portfolios. You can go to my paid site, jubakam.com, which actually has 6 portfolios, some of which are very useful at a time when you might want to hedge some of the market or find some ways to play it short. So we've got a volatility portfolio that looks at some ways to do that with options and hedges and ETFs. So thanks for watching. Talk to you next time.